Hello, everyone, and welcome back to the Saigal Seatrade podcast. I'm Research Analyst Shruti, your host today, and today's episode is packed. We are deep diving into the freight flows and fleet dynamics, and who better to make sense of it all than our returning expert, Mr. Sandesh Ghandat. Sandesh, welcome back.
Thanks, Shruti. Thanks for inviting me once again. It's pleasure to be here.
Alright then, let's get into it. So let's start right where the weight lies. The VLCCs. We have seen the Middle East Gulf rates crawling off the floor after weeks of bruising. Sandesh, are we at an inflection point or is this just a dead cat bounce?
Well, great to be back, Shruti, and you are right. The VLCC segment out of the MEG, that is Middle East Gulf, it has been like watching a boxer on the ropes and kind of absorbing blow after blow but refusing to go down. So early last week, we have seen the market was still reeling from the tonnage oversupply and kind of a drought in inquiry. And there were owners, they were being pushed around and sentiment was soggy. But then something changed midweek and it was not dramatically but noticeably. So we have seen the position list specifically for the early August dates. They started thinning and we began to see a resistance from the owners, not just accepting cut, but even the rate numbers. So there was a pushback and that is a kind of a psychological shift that matters. Because this isn't a cargo boom yet, it's a shift in behavior. And often in VLCCs, that the precursor to the rate movement. So we have a benchmark crude that is TD3C. We saw a 5.75% week on week jump to world scale 49.65. And then the another benchmark TD2 climbed by 4.67% to world scale 50.39. Not eye popping, the growth is marginal, but it is the first coordinated uptick in a while. And TD15, we have also seen it added around 5.94% week on week and it closed around world scale 53.5. So yes, maybe the worst is over for now, but I would say we are in a watch and wait phase because if August temps pick up, we could see some momentum build quickly. But without any consistent demand, this could flatten again. And owners, they are hoping for flow, but the ceiling is still to be decided.
Alright, so let's pivot to the Suezmaxes now, especially ex-West Africa and ex-Middle East Gulf. There's noise around firm resistance from owners despite sluggish demand. Are Suezmaxes holding their ground better than VLCCs?
Well, Shruti, it's an interesting contrast because, Suezmaxes, specifically ex-WAF, that is West Africa, they have been a less volatile but more stubborn because in West Africa, the story is still too many ships chasing too few barrels. But that's easing. We saw some of the owners drawing a line, especially after a slow start. And that shift when fixtures previously done at discounted levels, they came to light and allowed owners to push back. Now we have a benchmark TD20. It slipped, but slipped very, very marginally by 0.69% and it got settled around world scale 81.11 and then TD6 also fell very marginally 2.23% to world scale 90.39. So those are very mild drops and if you look under the hood, what you see is a stability driven by lack of tonnage and not a surge in demand. Now coming back to Middle East Gulf, it's a bit grimmer because the oversupply narrative is still intact. We have a fear of terminal congestion and then the possible sanction delays specifically around Indian interest and slowdown in long haul interest. They are keeping the segment on the edge. But owners, they are resisting deeper cuts. So it's a quiet war of attrition. We saw Indian PSUs quote 3 cargoes with the last MEG West Coast India fixture done at world scale 94, which again is holding the floor. So no breakout yet, but there is a resilience.
Well, the Aframax story feels a bit more lopsided, Sandesh. Pressure in both the Middle East Gulf and Southeast Asia. TD8 and TD14 are both sliding. So what's driving this downturn?
So Shruti, this is where the size starts to hurt because Aframaxes are under dual pressure. First from the tonnage oversupply and then the second from the price competition. So we have seen the TD8 benchmark, it dropped nearly 6% week on week to world scale 141.71. And while TD14 fell by 4.53% to world scale 115.88, we have seen these drops are not that significant, but in the MEG activities is heavily off market. So we have seen the fuel oil steams that used to give Aframaxes a floor are few and far between. So the Suezmax segment with its lower rate is kind of a pushing Aframax demand. So in the Southeast Asia, it's even more depressing because we have seen the TD14 benchmark. It has a weakness from the front-loaded position list and no meaningful second decade activity. So owners are trying to hold the line, but with the LR2s and LR1s increasingly cross-competing specifically for the cleanup or hybrid trades, Aframaxes are left scrambling. Now, we have seen Indian PSU only quoted one cargo last week, which tells you how tight the demand is, and even that was covered at world scale 142.5, and it's hardly a bullish number.
So let's switch gears to the clean tanker market now. The product tanker market has been fascinating. LR1s seem to be the flavor of the week, but LR2s are absorbing most M's. How should we read this?
Well, Shruti, this is one of the most tactical clean tanker markets we have seen in the recent history, because we have benchmark TC5 rate, that is cargo going from AG to Japan on LR1s. They have jumped by world scale 6.25 points to hit around world scale 143.75, and that's a 7.5% week on week rise in earnings, and the earnings they were around $20,560 per day. But LR2s, you know what, they have slipped. TC1 dropped around 7.48 points to world scale 111.96, and then we have seen with the TCs it dropped significantly by 13%, just above $20,920 per day. And you may ask why? Because charterers, they are playing the supply game. LR1s are tight, so they upsize to LR2s, and now LR2s are busy clearing front end tonnage while LR1 rates keep rising. So the forward curve, it sees Q3 TC5 at world scale 137.5 versus world scale 143.75 for Q4, and that is what the contango market look like. The contango, it means the market expects LR1 demand to only get tighter. And then there is another benchmark TC17 AG to East Africa. We have seen that route surge by world scale 25 points to world scale 216.07, and even here also TCE increased around 16% to just about $21,000 per day. That's your clean tanker MVP for the week. We have seen the mid-size clean product tanker, or we can say that MR tanker, they are also tightening. So in the AG, we have seen the 44 MRs, they were ballasting back for loading at different ports in the AG, but amongst the 44, 21s are already subjects or going to be subjects or COA linked vessels, because we are not sure whether all the vessel getting fixed or not. So that gives a story, and that story is this: the tonnage list is rapidly thinning. So we are down to 0.12 million metric tons of expected CPP lifting in the upcoming week, and owners are kind of regaining the leverage.
Well, Sandesh, let's talk about the Americas. We have seen MR rates spiking post July 10th, and now with Trump's new 50% tariff on Brazilian imports, it feels like geopolitics is redrawing trade maps. So what's happening here? And is there any opportunity for Indian refineries?
Shruti, this is a kind of a textbook trade distortion, and it's creating asymmetric opportunity. First, let me tell you about the freight semantics here. The US Gulf Coast Chile trade, the rates for reached around $2 million. And then we have a Brazil to US Gulf Coast, the rates jumped to around world scale 175. You may ask why? Because yes, tonnage is tight. We have seen over 10 MRs, they went on the subject in just few days. Now layer on Trump's tariff move on that, because the new tariff move around 50% on Brazilian refined product import starting from the 1st August 2025. So in Brazil in 2024, they imported around 216 million barrels of the products. And in the first half of 25, their imports rose to 21% year on year to 41.1 million barrels. But we have seen the gasoline imports, they fell by 21% year on year to 6.3 million barrels. But still, the US supplied around 25% of Brazil's diesel and 35% of gasoline. So this new tariff implementation, it's kind of a shock to the Brazilian market, and then this particular shock opens a clean corridor for the Indian refiners. Specifically, those are there in the west coast of India. And west coast India to Brazil is kind of a geopolitically neutral and avoids the Red Sea. So for the ship owner's perspective, it's a favorable sea route, and this is where Indian refiners can step in and earning premiums for the mid distillates and plunging Brazil's widening fuel gap. If that happens, the MI employment will surge, and it's not just about the freight. It's a diplomacy, energy security, and price arbitrage coming together.
So finally, let's touch on LPG. The East looks strong and the West looks tight. Are we seeing a return of bullish sentiment?
Well, absolutely. In the East, Indian PSUs were active last week, and VLGC clocks in the TCs in the low $80,000 per day, which is robust when the benchmark against BLPG1, and that kind of a return will pull dates forward. First or second half of August 25, it looks firm. Now, some vessels, they are ballasting back to the US Gulf Coast after doing these India runs, which could, shift the sentiments. If we see too many vessels, they return at once, but if they don't, we kind of see tighten up in the tonnage leads and rates make a hold in the segment. So in the West, freight held at $130 per metric ton, and we have seen the Indian charterers and stronger US Gulf China interest have tightened the list. So we have seen the Houston Chiba is averaging around $129 per metric ton, but with the more August end USG stems likely after the weekend, owner seems optimistic. So expect the market to either hold or climb moderately. It's not the explosive yet, but there is a clear bullish undertone building.
Well, Sandesh, that was sort of a masterclass, and thank you for walking us through all of it.
Thanks, Shruti. Thanks for inviting me once again, and it's always a pleasure to be here.
And to all our listeners, do not forget to share and subscribe to our podcast. And until next time, navigate safely and stay tuned.